Hey guys, welcome. Happy Wednesday. We're on episode 10 of the Money Show, and we have some interesting things to talk about. Sorry, I'm a little late, at least to announcing it, because I kind of had an emergency in the last 24 hours. Yes, and I don't know how I'm going to share with y'all, but I'll share a little bit about it soon. But the question I have before we go into the topics for today is how much of your emergency fund could you spare for immediate availability? And I'm asking you that for a reason you will see in a little bit. If you're on the replay game, let me know. Let's say you have an emergency fund of $10,000. How much of that could you afford to take away from your emergency fund because you weren't going to touch it anyway and it could possibly grow you money? So if it's 10,000, I'd probably say like 250 that I could have where like I would not miss that, That's what I would say. The table of contents that we're gonna talk about today, please let me know if you guys can hear me when you guys do come in, are that bonds may be a financial opportunity with what happened last month in the stock market and how the bond market subsequently actually stopped the tariffs. I started looking more into bonds, and I'm going to give like a little crash course of what they are. The next thing is we're going to talk about there not being a US Postal Service anymore because they are doing bad financially. And really quickly, I'm going to wrap up with talking about the price of golds because I think I'm going to monitor that every a good amount of shows every time I can get a chance. And I feel it's monumental. So back to the question, how much of your emergency fund could you spare for immediate availability? I put 1,000. I can spare $1,000. Hi, whoever's in here, welcome. Say hi, and then go ahead and answer the question for me. How much of your emergency fund could you spare for immediate availability? And the reason why I asked that is because we're going to talk about bonds 101. Bonds made simple, because I always avoided bonds when learning about personal finance because they were confusing to me. They're not anymore though, and now it got me wanting to buy bonds. So what is a bond? A bond is an IOU to the government or a company, and actually it's an IOU given to the person who buys the bond, given to you by the government you buy the bond from or the company. You are the investor, and so that would be me or whoever's watching, and we give them a lump sum. So I remember, like, I think in this last slide I said $1,000. So I would give $1,000 to the US Treasury and purchase a bond, and they get my money, and they get to do whatever they want for it for, I think, minimum 10 years, but let's say it's 5 years. So ultimately, I am the government's bank, or I am the company's bank. Companies do this as well to raise cash flow, to improve operations, or maybe grow the business. The government or the company pays you interest yearly and holds the loan to build the business. Some important terminology to consider is a maturity date, and that's the date when investors get their money back. That's usually 10 years. So if I were to buy a US Treasury bond for $1,000, they're going to pay me back in 10 years. They get to keep my money, but each year they give me a payment, which is interest. And when everybody was selling off those US Treasury bonds because we was over here acting them up with the tariffs, in order to keep money flowing into the US government for them to fund the government, they had to increase the rate. They had to pay people more to get their money to fund the government. There was a term called coupon that I discovered, and a coupon is the interest rate payment made by the company 1 to 2 times a year. So let's say my bond for $1,000, I get 4% on it. That means every year I get $40, and they will either pay me $40 one time a year, or they'll pay me 2 payments of $20 2 times a year. And what's cool about that is that is not taxable. So it's tax-free money, which is really cool. And if you got billions of dollars, like apparently Japan's government and Chinese government had or investors had in the US Treasury, they were getting fixed income streams. Because if they have millions of dollars in a US Treasury bond, the US Treasury pays them 2 times a year. It's fixed income. Callable is another term that I came across, and callable means that bond can be sold and you can get the principal back early. So I guess there are bonds that are not callable. So once you buy them, you're not getting it before 10 years. But that's nice to know, because when I was like, well, what if I need my $1,000? This here $1,000 from my emergency fund. What can I get it back? It makes sense that it does come with a penalty, and you do have to report the task. And the last thing I put is that the government or the company cannot repay the loan, the money loan back. That is a risk that we have, but we're gonna see, like, there are just some companies that you really question if like they would ever go out of business, right? Some have happened, like Pan Am and Woolworth. So then bonds, are they an opportunity bond? Are they an opportunity now? So US Treasury bond, the 10-year one is about giving 4.22%. That's pretty high. That's higher than a high yield savings account. Procter and Gamble have bond between 4.8 and 5.5%, and Google has bonds between at around 2.2%. So I mean, I can't imagine Google slowing anytime soon before 10 years. So that's why I was like, let me look into it. I really started looking into it because I heard Google and Procter and Gamble were selling bonds, and I was like, I didn't even know you can buy a bond from that company. So we're gonna go to a website that sells them really quick. Let me see. Before pressing remove remove ad. Okay, guys. So this, if you go to public.com, they will show you a bunch of companies, and I just looked up Procter & Gamble specifically. So this one is Procter & Gamble. It gives you a 4.39% yield, and it tells you the maturity date, which is 2029. So this is 4 years. The coupon's 8%, and this is the price. So if you have $1,000, you'll get a little bit under 9 or 9 point something of them. And then down here, it gives you examples where it tells you the coupon frequency. So the payment frequency is semi-annually. Is it callable? No. Things to look at. Then there's a name for it, investment grade. Now, that makes sense because usually I see them as like 10 years or more. So probably the fact that this is for 4 years, they're not going to let you call it. But what I think is also cool is down to the right, it gives you other options that you can buy. Let me see. I don't want to mess this up. Procter & Gamble. Yeah. So, because this one's 4.39%, right? Over here, I'm seeing higher. So I'm like, okay, there's got to be a catch. And indeed, there is a catch. So the highest one, if I want to be greedy, 5.53%, that one matures in 22 years. But you get 5.3%. So that $1,000 that I said hypothetically, I can't get that. Well, I should leave it in there for at least 20 years. Let's see if it's callable. It is callable, which makes sense. They're probably like, there's a higher chance someone's going to need their money in 20 years. But if it matures in 4 years, they're just going to have to deal with it, right? So the coupon's 3.5%. So that's how much they're going to pay me. And I'll be honest, I'm not sure about the yield. What's the difference between the yields? I just focus because I'm a beginning learner. The 3.5% is what I'm going to get 2 times a year. The coupon frequency is semi-annually. And to buy one is $74. So if I had $1,000, I'm probably going to get like 12, 13. And then another company to think about, let me see, is, let me remove and then share another one. No, not that one. It's just, whoa. Okay, let's, what is that? I don't understand. I don't want to add to stage. Hold that thought, guys. Remove this. Present. I'll do stop screen. Yeah, okay, fine. Share screen. We're going to go to Alphabet. Alphabet's parent, that's a parent company name for what we know as Google. This particular one has a 5.31% yield, but the coupon is 2.25%. And this expires in like 35 years. Wow, that's a lot. It's cheap though. It's 51, so $51 and some change. If you do buy $1,000 of this, you're not gonna get it back for 30 years. So that's something to take account. And then on the right here, they have others where, okay, so this is 5.3. Let's do one that's a little bit less, 4.53. And if you go up, the coupon's even less, 0.45%, but it's being called, it's gonna be done in like 5 months. So you can shop and you can tailor it to the coupon amount you want to get paid, to how long you're willing to keep it. So I thought that was really cool. And I think I'm going to invest in bonds shortly, because in my emergency fund, I'm pretty sure I could spare a little bit and get tax-free income. I'm all for that. So how do we buy one? You can go to US Treasury bonds, you go to home.treasury.gov. And then for companies, I use a website called public.com to do my research. I haven't bought anything yet. So to ask the question again, how much of your e-fund could you spare from immediate availability? Let me know in the comments if you're replay gang. I said over here, $1,000. I think I could afford that. Right now it's about at 20. All right, so the next topic is the post office is having problems, specifically because the US Post Office is having billion with a B dollar losses. That makes sense because mail demand is continually low, and we know all of us know why. It rhymes with Shmamazon. Like, I feel like Amazon has been continuously coming at the post office's neck. And the US Post Office is finding itself struggling to stay relevant because of Amazon, also because bad service reputation and lack of facility investments. I know I'm not the only one when we go to the post office that they are dirty. Even the cleaner ones, like, I don't know why, if it's a US government establishment, it just is not kept nicely. Unless you're in a courtroom. Inside the court, those look nice, but it's a shame how government buildings look nasty. And it's just like, why is it because they're public? There's no pride in them. And then bad service. They're not always the nicest. And when you have issues, there's a lot of red tape. So people don't like to deal with it. They'll pay a little bit more with Amazon and UPS to know that there's going to be a sense of urgency. I feel like in the post office, there's no urgency among the people that work there. If you have a problem, basically is your problem and not theirs. I have one person in here say hi. I'm going to put hi in the comments. Say hi back. I'm friendly. Thanks for being here, by the way. And the bottom line is that in Q1 of 2025, the post office has lost 3.3 billion with the B dollars and having a net loss. But what would life be without the post office? So the pros of the post office is quicker service, cleaner experience, and a sense of national stability. You know, I just said it wasn't that quick of a service. So I don't know. I think it's more trusted. I feel people trust the post office. It may take a little bit longer, but it's just like a staple. And I will say, it's like everybody knows that they can go. It's kind of a universal right to have mailage, but I think that we take that for granted because what if it goes away? And there's a sense of national stability. But the cons that if we have a life without the post service, I fear it's going to be irreversible decision. So I think we need to get our butts in gear and find a way to save it. On top of that, there will be 600,000 jobs lost, is estimated. There's a concern about the strength of democracy because a lot of mail voting goes through the US Postal Service. And imagine a life where mail voting went through Amazon or FedEx or UPS. If the leaders of those companies are cronies with a particular candidate, you have to be concerned about, is your mail vote going to count? Another con is it messes up our historical identity. I feel like the post office has been around since the country's been around. There's concern for federal privacy standards being lost. critical legal document affordability. Like I know when you're doing your passport, you can get that done there. And just like if it's a legal document, the post office, regardless, is not going to hike up the price. But FedEx and UPS could do that because it's private and they have to answer to shareholders. And the con is that Amazon, FedEx would have monopolies and universal access would be lost. So it could be that if Amazon and FedEx are doing our mail, if they decide one day that they just don't want to go to rural areas because it doesn't meet their bottom line, then certain people will be marginalized out of having mail service. Now I understand why I put pros. So the pros are quicker service if you go to Amazon or UPS, cleaner service, and yeah, that makes sense now. The US Post Office, I would say some suggestions to keep it is that there should be a minimum 3-year focus on business turnaround. Higher executives and administrators accountability needs to be a key aspect of the business. And I think operations is where they should focus. And specifically, they should focus on making it efficient and cutting out things that confuse from point A to point B. And then also should fix personnel issues. So I think we should focus on their inspiration because they tend to like not be happy there. So maybe they need a raise. Even if you don't like a job, if they pay you more, you're willing to do more. And they need to do more because right now they just make you feel like you're lucky that I'm here. And then we also need to focus on accountability because if they have that attitude and at the same time they are getting paid more, you got to be out. Your job isn't safe. And then the last thing we're talking about is GOAT assets. I put here bright in red that opportunity to buy maybe now or very soon because we got 90-day reprieve, y'all. So I think if the stock market is good, the price of stock may go down. Actually, let me see something. Let me do MPEX. Is that it? Yeah, let's see. Gold. That's not the price. Anyway, let's get back to the thing. So January 1st, it was 2,639. At its peak, May 6th, it was $3,433. So almost $3,500. But May 13th, it went down at least $200 or almost $200. So it's trending down now. That's why I wanted to find the price. So I said the source was Amex. Let me see something. Which one is this? At the stage. Okay, let me remove. Okay. Amex Gold. Oh Lord. Yeah, I think my kitchen is flooding. Yikes. I did the show first. I'll tell y'all about that later. Let me see. Gold price. Price today. Okay. Think this is gonna help, right? Oh, no. Okay. Hold that thought. Remove. What is this? Stop screen. I think that's it. Okay. So price today is $3,200. So it's down because it was $32.57. It's down 57 cents. I'm telling you, as the stock market goes up this next 80 days, you might want to buy some gold. Options to buy gold is a 1 ounce bar, or you can buy stock. You can buy stock in mining companies. You can buy stock in ETFs, and you can buy stock in trading options. I think I'm going to start in mining companies because it gives a dividend, and there's one that I'm looking for that's in my price range of up to $200 per share. And that's it, y'all. That's the wrap up. I left this picture because yesterday, wasn't Monday, we were pretty high. We gained 1,100 points and we needed that. So I want to end it with like a high note. We're doing decent. And to wrap up, bonds are not a bad idea if you are sitting on some extra cash. I think I'm going to invest in that 2026, God willing. Once you think about, could you imagine a world without a post office? And I cannot wait to be able to buy some gold. Thank you guys for hanging out with me this week. Sorry it was short notice, but done is better than perfect. And I'm all about trying to stay consistent. See you next week.